But after a volatile past 3 months of trading, what are investors' biggest concerns for the market going forward? In CNBC's fourth quarter stock survey, 61% said it was a new wave of the virus. 27% answered slow economic recovery, which could also be related to that virus. And 12% said it was election uncertainty. Joining us now is JP Morgan Asset Management's Ben Mandel, as well as Amy Wu Silverman from RBC Capital Markets. Thank you both for joining us. Amy, let's start with you. How do you think stocks would react if there is a second wave of the virus?
Certainly not well. And unfortunately, when we look at our markets, the option markets, uncertainty is already extremely high. And that's been coupled, obviously, with other major events like elections. So look, if we get a second wave sort of in conjunction with the same time frame of elections, which, a number of people believe might be contested, and obviously with data points perhaps deteriorating around, a recovery being further off than hoped, I think those hedges grow larger and larger, uncertainty gets higher, and volatility gets more and more expensive.
Ben, what do you think? Would it look like it did in March? Is it simply just a mirror image? If there is another uptick, is it worse? Is it better if we do see a second wave?
I think it's more about volatility than direction here, in the sense that you have clear tail risk on the left side of the growth distribution that's coming from the prospect of higher cases, higher hospitalizations, and a policy response. On the other hand, you have a right tail risk coming from vaccine news, and markets are simply going to toggle between those tail risks over the coming months. So it's not a directional bet as much as it is a little bit more volatility here. We think in our baseline outlook that the U.S. economy is still relatively well supported here. An additional fiscal package is a nice to have, but not a need to have for things to be okay, in the sense that there's a broad degree of support for growth. And you can see that in the consumer numbers from this morning. So you have supporting consumer spending, government support, you have organic healing in the labor market, and you have saving rates, this big pile of dry powder that's accumulated over the last few months. And what you're seeing is that, even as income ticks down, consumption is still moving up. And so even in the absence of additional support, you're getting consumer spending down that saving buffer, and that's leading to above trend growth. And we expect that to continue over the coming quarters. And our default positioning here is still risk on, notwithstanding the caveat from the beginning that, there's more volatility around the virus and around election risk.
Shepard Smith here. Thanks for watching CNBC on YouTube.